The year is 2026, and while everyone else is glued to 5-minute charts, you're sitting quietly, watching a position that's been open for 37 days, and it's up 42%. They're chasing shadows. You're riding thunder. The difference isn't luck, it's philosophy. And what you're about to discover will separate you from 95% of traders who will lose money this year, not because they lack intelligence, but because they never learned to think like a turtle. There's a story that changed trading forever, and most people have never heard the full version. It started with a bet between two men in Chicago, a bet about whether great traders are born with some magical gift, or whether anyone, absolutely anyone, could be taught to extract millions from the markets using nothing but rules, discipline, and mathematics. One man believed genius was innate. The other believed it was systematic. They decided to settle it with an experiment that would create more millionaires than any university, any hedge fund, any trading floor in history. They took ordinary people, a government auditor, an accountant, a 19-year-old kid, a recording studio engineer, people who'd never placed a trade, and taught them one system. Within 4 years, those ordinary people made over $100 million. But here's what nobody tells you: the system was simple. Brutally simple. So simple that when it was written on a whiteboard, people laughed. They said it couldn't work. They said markets were too complex for such elementary rules. They were wrong. And their wrongness cost them fortunes, while the turtles, that's what they called these trained traders, quietly accumulated wealth that would last generations. You see, trading isn't complicated. We make it complicated because complexity makes us feel intelligent, makes us feel like we're doing something, makes us feel like we deserve the money when it comes. But the turtles proved something that terrifies the industry: you don't need to be smart to get rich trading. You need to be systematic. You don't need to predict where markets are going. You need to follow where they're already moving. You don't need to trade often. You need to trade correctly. And that last one, that's where everything falls apart for most people. Because in 2026, the disease hasn't changed. It's gotten worse. The technology is faster, the charts are prettier, the indicators are more sophisticated, but the psychology is the same cancer it was in 1983, when Richard Dennis first gathered his turtles. We're still terrified of missing out. We're still addicted to action. We're still confusing activity with progress. And the market is still taking our money, one impulsive trade at a time, feeding on our need to feel like traders instead of our willingness to be systems. Let me tell you about Michael. Michael wasn't a turtle. Michael is a composite of 1,000 traders I've watched over the years. And maybe Michael is you. Michael wakes up at 6 in the morning, not because his strategy requires it, but because he's anxious. He checks his phone before his feet hit the floor. Futures are down. His heart rate increases. He tells himself he's just checking, just staying informed, but really, he's already trading emotionally before the market even opens. He sits at his desk with 3 monitors, 17 indicators across 4 different timeframes, news feeds streaming, Discord channels pinging, Twitter shouting about the next big move. Michael is drowning in information, and he calls it preparation. By 10 in the morning, Michael has made 4 trades. 2 were stops, 1 is barely green, 1 is stressing him out. He didn't plan any of them. They just felt right. A breakout here, a dip there. Someone on YouTube said this stock was heating up. By noon, Michael is down $300 and feeling sick. Not because $300 will ruin him, but because he knows, deep down where he won't admit it, that he's not following a plan. He's following fear. Fear of missing the move. Fear of being wrong. Fear of being left behind while everyone else gets rich. And that fear is turning him into a slot machine addict, pulling levers, hoping for cherries, getting lemons, pulling again. Now let me tell you about Sarah. Sarah is a turtle trader. Not literally, she never met Richard Dennis, but she learned the philosophy, and it changed everything. Sarah wakes up at 6:30, makes coffee, and spends exactly 15 minutes reviewing her watch list. She's looking for one thing: did any market make a 55-day high? That's it. No predictions, no opinions, No guessing if it's sustainable or if it's a false breakout or if the fundamentals support it. Just a question: did it happen or not? Today, crude oil triggered. Sarah doesn't get excited. She opens her spreadsheet, calculates her position size based on the volatility of crude oil right now, enters her order, sets her stop at exactly 2 times the average true range, and closes her laptop. She doesn't watch it. She doesn't hope it goes up. She doesn't pray it doesn't go down. She executed the rule, and now the rule will play out however it plays out. By 10 in the morning, Sarah has been to the gym. By noon, she's reading a book that has nothing to do with trading. By market close, she checks once: is she still in the trade? Yes. Stop. Hit. No. Don't. She's risked 1% of her account. If she's wrong, she loses 1%. If she's right, she'll ride it for weeks, maybe months, adding to the position as it moves in her favor. Pyramiding systematically, letting mathematics do what emotions cannot, capture asymmetric returns. Do you see the difference? It's not intelligence. Michael might have a higher IQ. It's not work ethic. Michael is staring at screens 12 hours a day. It's not even information. Michael has more data than Sarah could process in a month. The difference is philosophy. Michael believes trading is about predicting and reacting. Sarah knows trading is about probabilities and patience. Michael is trying to be right. Sarah is trying to be systematic. And over a year, over 5 years, over a career, that difference compounds into millions of dollars and 2 entirely different lives. Michael will burn out, blow up, or quit, blaming the market, blaming algorithms, blaming anything except the truth. He never had a system. He had a collection of impulses dressed up as strategy. Sarah will quietly accumulate wealth, not because every trade wins, but because her winners are massive and her losers are tiny, and she shows up every single day, emotionless, mechanical, present. This is what the turtles understood that nobody wants to hear. The market doesn't reward effort. It doesn't reward hours studied or charts analyzed or opinions formed. The market rewards one thing: correct position sizing during sustained trends. That's it. Everything else is theater. And here's the part that makes people angry. You only need to be right 35 to 40% of the time if you're cutting losses at 2% and letting winners run to 20, 40, 80%. The math is undeniable. A 10 trade sample: 4 winners averaging 50% gains, 6 losers averaging 2% losses. You just made 188% on your risk capital while being wrong more than half the time. But nobody does this. You know why? Because being wrong 60% of the time feels terrible. It feels like failure. It feels like you don't know what you're doing. And so we adjust. We tighten stops to avoid the pain of small losses, and we take profits early to feel the pleasure of being right, and we completely invert the only equation that works. We make our winners small and our losers big, and then we wonder why we're broke. The turtle system wasn't invented in a vacuum. Richard Dennis didn't wake up one day with divine inspiration. He discovered, through years of getting destroyed and rebuilding, that human psychology is the enemy and mathematics is the savior. He discovered that trends exist because human emotions are predictable, fear and greed create momentum, and momentum creates exploitable patterns. He discovered that if you wait for price to confirm direction by making new highs or new lows over a significant period, you're not predicting. You're observing reality. And he discovered that if you size your positions based on how much the market is actually moving, not on how confident you feel, you survive the chaos and capture the magic. These weren't theories. These were battle-tested truths, forged in the commodity pits of the 1970s and 80s, when markets were wild and fortunes were made and lost in hours. Dennis turned $1,600 into $200 million. Not by being brilliant, by being systematic. And when people said it couldn't be taught, he proved them catastrophically wrong. He placed an ad in the Wall Street Journal. Applications flooded in, over 1,000 people dreaming of learning from a legend. He chose 23. Not the smartest, not the most experienced. He chose people who could follow rules. People who understood that trading wasn't about being clever, it was about being obedient to a process. And then he taught them something so simple it fit on one page. Buy when price breaks a 55-day high. Exit when price makes a 20-day low. Risk 1% of your account per trade. Calculate position size by dividing 1% of your account by 2 times the average true range times the dollar value per point. Add to winning positions at every half unit of profit. Never move stops away from the market. That was it. No indicators, no patterns, no news analysis, no macro predictions. Just rules. And those 23 people, those turtles, went out and made millions, not because the system was magic, but because they trusted it when it hurt. They took losses and didn't flinch. They sat in drawdowns and didn't quit. They watched other traders make money on quick flips and didn't chase. They became the system, and the system rewarded them. But let's talk about what nobody talks about: the psychological destruction that happens between trade 1 and trade 100. Because the system isn't the hard part. The system is laughably simple. The hard part is you. The hard part is sitting through 19 losing trades in a row, knowing that trade 20 might be the one that makes your year, and still taking it with full position size. The hard part is watching your account drop 15% over 3 months, while everyone on Twitter is posting screenshots of gains and not changing a single thing. The hard part is having your spouse, your parents, your friends ask why you're still doing this when it's clearly not working, and knowing that it is working, it's just not working right now. The turtles faced this. Every single one. They had the rules. They had the funding. They had the legend himself checking their work. And still, some of them cracked. They started skipping signals that didn't look right. They started reducing position size after losses to protect themselves from more pain. They started adding discretion to a system that was designed to eliminate discretion. And those turtles, the ones who couldn't handle the psychological warfare, made pennies while the faithful made millions. There's a turtle named Curtis Faith who was 19 years old when he started. A kid. No experience. No wisdom. Just a willingness to do exactly what he was told. And Curtis made $31.5 million by the time he was 23. Not because he was a genius, he'll tell you himself he wasn't. Because he followed the rules with religious precision. When the system said buy, he bought. When the system said add, he added. When the system said exit, he exited. He didn't ask why. He didn't debate. He didn't improve. He executed. And the market paid him for that execution because the market doesn't care about your opinions. It cares about your behavior. Curtis later wrote a book where he revealed the entire system, every detail, every calculation, every rule. People read it. Thousands of people. And you know what happened. Almost none of them made money. Because reading the recipe doesn't make you a chef. Knowing the system doesn't make you systematic. The gap between knowledge and execution is where fortunes die. And that gap is filled with one thing: your ego. Your need to be right. Your need to feel smart. Your need to do something instead of the correct thing. Here's what trading in 2026 looks like for most people. They open their laptop. They see green candles somewhere, and they panic that they're not in it. Fear of missing out isn't a new phenomenon, but technology has weaponized it. Every win is posted. Every loss is hidden. Every guru is showing you the trade they nailed, never the 12 they botched. And your brain, your poor, desperate, comparison-addicted brain, says you're being left behind. So you jump in. No plan, no stop, no position size calculation, just hope. And maybe it works. Maybe you catch a piece of the move, and you feel like a genius for 30 seconds. But then it reverses. And now you're stuck. Do you take the loss and admit you were impulsive? Or do you hold, hoping it comes back, turning a trade into an investment into a prayer? This is how accounts die. Not in one catastrophic trade. In 1,000 tiny decisions made from fear and validated by luck until luck runs out. The turtle system is the antidote. It removes you from the equation. It doesn't ask how you feel. It doesn't care if you're confident. It observes price, calculates risk, executes position, manages exit. Boring. Mechanical. Profitable. Let's talk about position sizing, because this is where the magic hides and where everyone fails. Most traders think position sizing is simple. You decide how many shares or contracts to buy based on how much you want to risk. Wrong. That's not position sizing. That's guessing. Real position sizing is based on volatility, and volatility is the market's way of telling you how dangerous it is right now. If natural gas is swinging $5,000 a day and bonds are swinging $500 a day, should you risk the same dollar amount on both? Of course not. But people do. They buy 10 contracts of whatever they're trading because 10 feels like a good number, and then they get destroyed when the volatile market moves against them and their stop is hit instantly. The turtles used average true range, a measurement of how much a market actually moves each day, and they divided their risk by that number. If your account is $100,000 and you're risking 1%, that's $1,000. If gold has an ATR of $25, you can trade 40 contracts. If crude oil has an ATR of $2,000, you can trade 0.5 contracts. Different position sizes for the same risk. This is what keeps you alive. This is what lets you take 50 trades, lose on 30 of them, and still be profitable because your losers are all the same small size, and your winners scale up as they prove themselves correct. And that's the other piece nobody does, adding to winners. We're taught to average down, to buy the dip, to lower our cost basis. That's how you go broke. The turtle way is the opposite. You add to positions that are working. If you buy at $100 with a stop at 98, and the market goes to 102.50, you add more contracts and move your stop to 100.5. Now your first position is protected and your second position has room to run. If it goes to 105, you add again and move stops to 103. You're pyramiding, building a bigger position as the trend proves itself, but you're never increasing your risk. If the trend reverses and stops you out, your first units made money, your second units made money, and only your last unit took a small loss. Net result profit, even though the trend ended. This is how the turtles turn thousands into millions. Not by being right more often, but by being bigger when they were right. But this requires something most traders don't have: patience. Not the patience to wait for a setup. That's easy. The patience to wait through the setup doing nothing. To sit in a trade for 40 days while it chops around, hits your stop, and then triggers again, and you take it again, and it chops again, and you take it again, knowing that all of this pain, all of these small losses, are the price of admission for the one trade that runs for 6 months and makes your entire year. The turtles knew they'd lose money on 60% of their trades. They budgeted for it. They expected it. When a trade lost, they didn't question the system. They celebrated that they followed the rule. Because the rule, over 100 trades, over 1,000 trades, has a positive expectancy. The math works. The only variable is whether you'll stick around long enough to let the math play out. In 2026, the obstacles are the same but the noise is louder. You've got algorithms front, running orders, you've got retail traders with instant execution, you've got influencers screaming about 10 baggers, you've got group chats where everyone's posting wins and nobody's posting losses, and you've got your own mind whispering that maybe this time is different. Maybe the system doesn't work anymore. Maybe you need to adapt. And that whisper, that's the devil. Because the system does work. Trends still exist. Human emotions still drive momentum. Mathematics still governs outcomes. What doesn't work is you trying to improve something that doesn't need improvement. The turtles from 1983 are still trading today, 40 years later, some of them using the exact same rules. And they're still profitable. Not because markets haven't changed, they have. But because the underlying truth hasn't changed. Prices trend, volatility creates opportunity, and discipline captures edge. If you add indicators, you add failure points. If you add discretion, you add emotion. If you add complexity, you add confusion. The system works because it's simple. Your job isn't to make it better. Your job is to execute it perfectly. So let me paint you a picture of what your trading could look like if you embraced this philosophy. Imagine waking up without anxiety. You're not worried about missing a move, because you know that if a real trend is forming, your system will catch it. You're not glued to your phone, because your positions are managed by stops, not by hope. You check your signals once a day. You see 3 potential setups. You calculate position size for each. You enter your orders. You set your stops. You close your laptop. You go live your life. Days pass. One position is stopped out for a 1% loss. You don't care. That's the game. Another position is chopping around break-even. You don't care. It'll either hit the stop or it won't. The third position starts moving. 5 days later, it's up 3%. You add to it. 10 days later, it's up 8%. You add again. 20 days later, it's up 20% and you're riding 3 units, all profitable, with stops moved to lock-in gains. 30 days later, it reverses and stops you out for a 15% total gain on the sequence. You just made 15 times your risk on one trade. You were wrong on one trade, chopping on another, and this one win paid for 7 losses and still left you ahead. That's the turtle way. That's how math beats emotion every single time. But you have to be willing to look like an idiot for months. You have to be willing to sit in drawdowns while day traders are bragging about scalping $50 on every tick. You have to be willing to miss explosions because you're waiting for confirmation, and by the time you get in, the move is already 10% gone, and people laugh at you for buying highs. Let them laugh. Because you'll be there for the next 40% while they got stopped out trying to predict the bottom. The turtles weren't heroes in real time. They were mocked. People said they were lucky. People said Dennis just had deep pockets to absorb losses. People said it wouldn't work in real markets. And then the results came in. Year after year. Turtle after turtle. Millions after millions. And the critics went silent, not because they admitted they were wrong, but because they moved on to the next thing to criticize, while the turtles quietly compounded. There's a psychological shift that has to happen, and it's brutal. You have to stop thinking like a trader and start thinking like a casino. The casino doesn't care if it loses 10 hands in a row. It knows that over 10,000 hands, the math is in its favor. You have to adopt that mindset. You're not trying to win this trade. You're not trying to win today. You're playing a game that's measured in years, and the only way to stay in the game long enough for the edge to manifest is to risk small, follow rules, and detach from outcomes. Every trade is just data, win or lose. It's information feeding into the system, proving or disproving the edge, and as long as you're executing correctly, the edge will appear. But if you deviate, if you skip signals, if you revenge trade, if you overtrade because you're bored, if you take profits early because you're scared, you break the system. And a broken system has no edge. You're just gambling, hoping your gut is smarter than decades of proven mathematics. It's not. Let me tell you what happens to traders who don't embrace this. They spend years searching. They buy courses, they try indicators, they switch strategies every time they hit a rough patch. They learn head and shoulders, they learn Fibonacci, they learn candlestick patterns. They learn Elliott wave. And none of it works because none of it addresses the real problem. They're undisciplined. They're trading their emotions with a thin veneer of technical analysis to justify it. And the market doesn't care about your justification. It takes your money and gives it to someone who's systematic. I've watched traders spend $50,000 on education, another $20,000 on software, and they're still broke because they never learned the one lesson that matters: follow the process, ignore the outcome, repeat forever. The turtles didn't have fancy tools. They had calculators and phone calls to brokers. What they had that you don't is faith in mathematics over feelings. They trusted that if they executed the system perfectly, the results would take care of themselves. And they were right. Now, here's the part where I tell you exactly how to start. Not theory, not inspiration, execution. Tonight, you write your rules on one page. Entry 55-day breakout or 20-day breakout, pick one. Exit 20-day low or 10-day low, match it to your entry. Stop, 2 times ATR from entry. Position size 1% of account divided by ATR times dollar per point. That's it, 4 rules. A child could follow them. But you won't, because your ego will say it's too simple, there must be more, and you'll add a volume filter or a moving average confirmation or an RSI check, and you'll ruin it. Complexity is the disease. Simplicity is the cure. Write the rules. Tomorrow, you backtest. Pull up 20 charts. Mark every time your rule triggered. Calculate what would have happened. You'll find that most trades lose small, and 2 or 3 trades make huge gains that dwarf the losses. That's the edge. It's right there. You don't need to believe me. The data will show you. Then you start paper trading. Not because paper trading makes you a trader, but because it builds the habit of execution without the emotional interference of real money. Take every signal. Size every position correctly. Set every stop. No exceptions. Do this for 50 trades. Track everything. When you can execute 50 trades with 0 deviations, you fund a real account with money you can afford to lose. And you start small. 1/10 size. Your goal isn't profit, it's perfection. You're learning to trust the system under real conditions. When you can do 50 trades at small size with 0 deviations, you scale to full size. And now you're a turtle. Not because you met Richard Dennis, but because you adopted the philosophy that made the turtles rich. The market is not your enemy, your emotions are. The year is 2026, and most traders will fail. They'll chase artificial intelligence signals that don't work. They'll day trade themselves into oblivion. They'll swing trade based on hope. They'll quit when the pain gets too real. But a small group will succeed. Not because they're smarter. Not because they have better tools. Because they figured out what the turtles figured out in 1983. Trading is not a game of prediction, it's a game of probabilities. It's not about being right, it's about being systematic. It's not about working harder, it's about thinking clearer. And the clearest thought you can have is this: I will follow my rules no matter what I feel. That sentence, internalized and executed, is worth more than every course, every book, every mentor you'll ever encounter. Because the information is free, the execution is priceless. And the market will pay you for execution every single time, while it punishes everyone else for their opinions. So here's your choice. You can keep doing what you're doing, chasing, guessing, hoping, stressing, losing. Or you can become systematic. You can adopt the turtle philosophy. You can trade less, risk small, ride trends, and let mathematics do the heavy lifting. You can spend less time staring at charts and more time living your life, knowing that your system is working even when you're not watching. You can stop being a trader and start being a trading system that happens to be human. The turtles proved it's possible. 40 years of results prove it's repeatable. Thousands of traders prove it's accessible. The only question left is whether you'll actually do it. Whether you'll write the rules tonight. Whether you'll take that first systematic trade tomorrow. Whether you'll stick with it when you're wrong 6 times in a row and everyone around you is telling you to quit. That's where fortunes are made, in the space between knowing and doing, in the gap between comfortable and correct, in the moment when you choose process over profit and trust that profit will follow. The market is open. The trends are forming. The opportunity is waiting. And somewhere right now, a systematic trader is taking a signal, sizing a position, setting a stop, and walking away, knowing that over 100 trades, over 1,000 trades, the edge will compound. That trader used to be confused, emotional, desperate. Now they're calm, mechanical, wealthy. The only thing that changed was philosophy. The turtles handed you the map. The only question is whether you'll walk the path. Day 1 begins now. Not tomorrow. Not after you learn one more thing. Now, write the rules. Take the trade. Become the system. And let 2026 be the year everything changed. Not because the markets changed, but because you finally did.